What's going on, guys? So welcome to the first video of the options channel. If you've been following me on the futures slash prop firm channel, that's just Cove Trader, and this is the Cove Trader options channel where we're going to mostly put up options videos, some stock stuff, and you're going to see me use different tools than I use in the prop firm world. So yeah, well, welcome to the new channel. I mean, I'm just going to go over some basic stuff in this video just to get you basic knowledge of what it is and what I mostly do. And then the videos will progress into more advanced stuff. So just basically an option is a contract basically to buy or sell 100 shares. So argument's sake, this is the options chain. The strike price, which is the price that Tesla, would be at. I guess the contract that you're willing to buy the shares at is 270. If you would buy this option, you're paying a premium. Well, we're just going to go on the ask. This is the bid, the ask. You'd pay $795 for the option to buy 100 shares at 270 when it expires on November 1st. So that's what options are basically about. And then on this side, you would basically be paying $855 for the option to short 100 shares at 270 come the expiration date. You do not have to hold it to the expiration date. Most people do not hold it to the expiration date, but that's what it represents. And then you can go out of the money, which is further away from the current price, either down to short or up. And that's pretty much the basics. So you can buy calls, which is you think it's going to go up, and you would buy the shares at 270 thinking that it would be up. You got to remember, if you're willing to pay at 270, it's 270 plus the premium. So your break even is about $278. And to the downside, if I would buy these puts, my break even would be about $261.50. So you got to keep that in mind, what the premium represents, what the strike price represents. And that's kind of the gist of that's just buying calls and buying puts. We're going to get into more of what I do, which is, I feel like, much safer. Also, I never buy 1 week out. I'll sell 1 week out, but I will not buy 1 week out. And we're going to go into the strategy I use and everything like that right now. So what I use is basically, they call it the wheel strategy. So say Tesla is a bad example of where it is currently because it's recently ran a lot. But the wheel strategy, I'm going to explain it here, and then I'll show you more of stocks that I would get into currently. So the wheel strategy would basically be selling puts. So I sell cash secured puts, which means I have the cash in my account to cover buying the stock. So argument's sake, just for an example here, say I sold these puts. So basically, if I sell puts, I collect the money. Now I'm no longer paying the money. I'm selling it. So I'm collecting $7.15. The strike price is $267.50, which if you take the strike price and minus the premium, basically, as long as Tesla is above 200, and we'll just round $260 by next Friday, as long as it's over that, I would have broke even or made money. Once it goes below $260, I basically start to lose money because I'm basically saying I'm willing to buy the stock at $267.50 plus I collect $7.15 of premium, so it kind of offsets your cost. So you're basically buying the shares at a discount. That's kind of what this strategy allows you to do. It it allows you to buy shares at a discount. Now, if I sell the puts and Tesla just goes up, and on Friday it's at 275, these contracts would have went to zero. I would have collected, if I sold one contract, I would have collected $715, and I would have made all my money. So you're basically saying that you think Tesla is going to be above 267.50, and you would have collected the premium. And then on top of that, the good thing about this is you don't have to be right. For argument's sake, say I sold these at 262.50, I collect $5 of premium. If Tesla goes down from where it's at and it's at 263, Tesla would have went down, we would have made money. If Tesla went up, we would have made money. If Tesla stayed the same, we would have made money. That's what makes this strategy more of a winner than anything else. It allows you to be wrong to a degree and still earn. Now, worst case scenario, if I like Tesla and Tesla drops to 260, I would basically, I would still make 50% of my money, because these contracts would be 262.50 minus the $2.50, because now it's at 260, but I collected $5 of premium. So the contracts would only be worth 250 at close, and I would have made 50% of my money. You have the option then to buy the shares, or right before it closes, you buy the contract back. Basically, you would have sold to open, so you buy to close. And then, that's pretty much how, you'd close out, so you don't have to you don't have to keep the shares over the weekend. And that's pretty much the simple way to do it. The only problem is, if say I sold these $5, I collected $5, and Tesla goes to $300. Well, you made $5, but if you bought the shares, you would have made $30. So it comes with a downside. The most you can make is what you sell it for. That's the most you can make. The most I can make is $5. But, you're building in a safety net. Tesla can drop, I don't know what exactly it's at, but say it's at 270 right now. Tesla can drop $12.50 and you'd still break even. So there's definitely a safety net built in to doing this. All right. So now there's a scenario of, say I sold these for $730 or $715, and Tesla goes below the strike price, and I'm given the shares. Say it goes to 260 and we break even. So I'm given the shares at a cost basis of 260. Well, then what I would turn around and do, actually, you know what? Let's say Tesla stays the same, just so we can use these numbers. Say Tesla stays the same, right where it is. And I sold these for $840, and Tesla is right where we're at. It's right under 270. Say it's at 269, I don't know, 269.80. These contracts would have went to zero by Friday, but they would have went to like 20 cents. Now, if you want, you can get assigned the stock, and then on Monday, you sell covered calls. So even if you do get assigned the stock, you then sell covered calls. So you're making premium up here. And if you happen to get assigned the stock, you then sell covered calls to collect premium again. So there's a lot of ways that you're collecting premium that you have to be really freaking wrong for you to almost lose money here. So, argument's sake, say another way. Say we did these 262.50s, and Tesla dropped down to 255, and you held, which means you're now down. Tesla dropped $15, but you're only down $2.50. Well, the next week, when you are assigned the shares, the 255 calls are going to be somewhere around $7 or so. And then you would sell those calls against your stock, that you would have made back that 250 and then gave yourself another $5 of safety net. So now Tesla can drop another $5 and then you'd break even. While the whole time the stock is down, the stock could be down freaking 20 something dollars here, but you're basically keep offsetting your losses by selling premium, that you're still good. And that's the power of selling puts. And then if you are assigned the stock, you sell the calls against it. But you only do this with companies that you don't mind owning the stock. So that brings me to the other thing. When you're doing this, you can't just randomly pick companies. You got to pick companies that you like owning, but also you got to bring them up. You got to bring them up on the chart. Like, for argument's sake, people like Tesla. But am I going to do this when Tesla's at 269.85 or 269.19? No, not at all. Because what happens if Tesla comes all the way back down at 230? I would have lost on my puts, and then I would have got assigned the stock, and then I would have sold calls. And yeah, my average cost might have been 255, but 255 is all the way up here. Like, that's not safe. This can easily trade back down to fill the gap. So this would not be it just wouldn't be a stock where it currently is that I would be willing to do this on. Now, I did this recently on Deck. Deck had earnings. It was at 151, and I sold 142s, which are all the way down here. So I collected $3. This was on Thursday. So basically it expired in one day. I sold $3. So basically I sold 142s, I think it was. So my average would have been 139 with premium collected plus strike price. I don't mind owning Deck down here. Look at where it would be. It would be all the way down. It'd be all the way down here. You got to remember also there's earnings premium built in. When there's earnings premium built in, it's a good time to sell options. So I said, hey, I don't mind buying this at 139. Sure enough, it went up. The options went to zero. In one day, I collected $310. It was over. Yes, if I bought the stock, I would have made, instead of $300, I would have made, what is that? I would have made $1,600 if I bought the stock. But the safety net I built in was this thing had to drop almost 9% for me to start losing money. So I didn't think it would be down 9%. So right there, I had a safety net. Like, this could drop 5% and I still make money. It could drop 8%, I still made money. So, and if it went up just a little bit on earnings, the juice would have got sucked out of the options. I would have made it right there. So I have a little watch list of things that I look at. I have indicators and things like that. I look at revenue growth. I look at companies I don't mind owning over a long period of time, because sometimes you can get stuck in this strategy. It's just the way it is. And it's one of those things that if you don't mind owning it, like Amazon. Hey, listen, if I get stuck in Amazon, I don't think Amazon's ever going to trade below 150, So it's kind of like, let's see what Amazon would be. Let's see what the premiums are. Options chain. So, you could buy, you could sell, 180s for $3, which would give you an average cost of 177. the 200 moving average is right around there. So, hey, maybe, the problem is obviously Amazon has earnings, but, like that's not a terrible play. Earnings kind of scare me. You never know what you're going to get. But, it doesn't always have to be a big company either. Like one that I really like is Snow. I think Snow is going to be a major player down the road. So we've recently retraced a ton. Actually, let me get these pivot points off, clear up the, it's definitely retraced a lot. I look at valuation. I looked at sector. Like I like Net. I don't mind owning Net. Like, Net's one that I just can own for a very long time because cybersecurity is not going anywhere. So I think you got to put together a list of companies that you like, but that also move around. Like, if you like Bank of America, but you're not going to get any options premium on Bank of America. So, a couple things come into play. One, stocks that you want to own for a long time. This is a good way to get them at a discount. And then you can go the other way where you can like sell leaps. I know somebody that sells leaps. And this is the selling portion of it. The other portion is the buying portion of it. The buying portion of it is when you see a stock that's pretty far down. SE was a good one. Like, you can buy at the money, but like further out, and then sell if even further out one where you create a vertical spread and you get that option at a discount. I never just buy options. Sometimes I do, but I always offset it some way. So to go a little bit more advanced, say we're looking at Amazon, and I love Amazon. Say I love it, and I'm like, man, earnings are going to be great, but the premiums are high because of earnings. I might sell the 180s and collect $3. And then what I might do is I might buy these for $5.55 and then sell these for $1. So I collected $3. I collected $4. So now this only cost me $1.45. And my max gain is $2.05 to $2.05, which would be $15. There's all different strategies you could do to offset your cost of options and things like that. But the biggest thing is obviously to start off generating income, selling cash secured puts. And that's where my core becomes. I'm always creating revenue and income doing that, which allows me to take risks that could basically go to zero. And I think that's where I'm going to call this video here and let it sink in. And if you have any questions, go in the Discord and ask. So there's a Discord. It's free. It's in the video. It's at the bottom. I would say this is a lot of information to take on right away. If you want, you should Google some of this stuff. You should watch some other YouTube videos about it. You could ask in the Discord. You can come on my live stream. You're on this channel, but go to Cove Trader and come on my live stream every day. Ask questions there. And I think that's just a lot of knowledge for somebody that doesn't know anything. It's 20 minutes of knowledge. And I think that you should start looking at stuff yourself. And then I'm going to try spitting out another video tomorrow that goes a little bit further. I just don't want one big video of like an hour to like overwhelm people. So I think that's where we're going to call it. And I'm around, obviously, Discord everything else, comment on the video, and let me know what you think. All right? I shall see you guys on the live stream.